Mhm. Good day, everybody. This is Jim Kinney, Option Professor Weekly Market Update for September 28, 2018. As always, we do remind you that past performance is not necessarily indicative of future results, and short-term trading and option trading is not right for everyone. So what you should do is consult your financial advisor, broker, clearing firm, and your good common sense to find out what, if any, things we're talking about may be right for you. Today, what I'll be doing, as always, is giving you my viewpoint and my opinion. And we're going to start out today talking a little bit about the big news of the day, which is obviously going on at Tesla and with Elon Musk and the government. It appears that there's some serious things going on over there with regards to some of the comments he's made, etc. And so the stock is getting whacked very hard today. I'll pull up the Tesla chart so you can get an idea. And obviously, the big concern is if he gets kicked out of the company, can this company go on without him in the front seat? And there's a lot of people, obviously, who think that may not be the case. Right now, you're looking at a stock that at one point when they were talking about maybe going private, jumped up to 390 there, as you can see. And then when it seemed like that was made out of paper mache. We sold off big time down at 255. Then we rallied back to 315, and then today it's down about 12% or better, almost down $40 a share. You can see the big gap down. If we take out 255, obviously that would be making new yearly lows. 244 is the yearly low, so take out 244, and you may fall into the abyss a little bit here because this is a company that's been burning cash. This is a company that's been basically a thematic company and basically a following the Pied Piper type company. And those believers who never would sell the stock, they may change their tune, obviously, if Musk has to be taken out of the picture. So right now you see the big gap down. And obviously, if we can, and it filled that gap, maybe it's something technical here. That'd be something to look at. You see the gap right there on the chart that I'm showing you. It's just a little bit under 270, which is what we're hitting now. And so let's see if whatever low is hit today holds up next week. And if it does hold up next week and that gap is filled, maybe there is a buy down here on the big bad news. But if you start taking out the 255 area, obviously something structural might be going on. And when something structural going on is, stand aside and things like that. Hedging, which I always talk about on this broadcast, using covered calls or using calls and puts together or just puts alone. These things are not bad things to have when either something's had a big run up or you're concerned about the future price. Again, OptionProfessor@gmail.com. Which I'll remind you about at the end of the broadcast, is a way for you to get more information on how hedging works, what's the different uses and risks of the hedging tactics, and be more aware of what's going on so it's a tool in your toolbox you can use and use comfortably. Okay. So that's basically what's going on there. The big thing also this week is obviously the hiking of interest rates by the Fed and their indication that there's going to be another hike. I would like to this week go over what some of the consumer type companies, like in housing and in retail might be doing, because it might be telling us something that the Fed is trying to slow things down a little bit. Again, the whole planet, as far as I hear, is looking for a 10% melt up in November and December, possibly after the Republicans run the cards in the election for the midterms. Now, that is a very popular thought pattern, which makes it either going to happen, or it could be buy the rumor, sell the fact. So I don't know exactly how it's going to shake out, but there is a large contingency looking for this huge run up at the end of the year. Is it going to happen? It could happen. We did make new highs, right, on the S&P, but on the other hand, with the popularity of the opinion and the Fed looking like they are trying to slow things down a bit, then basically that could be a situation where it does not happen. You have to always be careful and have humility whenever you make forecasts, because you could be wrong. Right now, again, let's take a look at things that look a little bit like they're having a little bit of trouble here. Let's look at a retailer like Walmart. And again, you topped out on Walmart at 110, so we're nowhere near 110. 110, and it did pop up quite a bit after its last earnings. Let me get the graph up here for you. And that's a graph of Walmart. There is a gap between 90 and 95. It may go down and fill that. If it starts to break above 100, though, that big rally at the end of the year based on the consumer going nuts, among other things, that might be in the cards. So if you see this thing trading above 100 and you want to make a bet that we could get the big advance at the end of the year, then that might be a little bit of a signal that that could be happening. Likewise, under 90, it could be a situation where, that's the end of the story. Do you see the volume when it gets very, very high, like it did at 105? Sometimes that's a high point. And look at the volume in the middle of August when it went to 100, very large. What's the volume been since? Very low. So was that a blow off high to the upside? Right now, there's evidence that it could be. So from that standpoint, that's a question mark on the consumer as far as the spending at a place like Walmart. Let's take a look at Macy's. Macy's was running up pretty big off of those lows when people thought they were, pretty much going out here. It went all the way down, as you can see, Macy's all the way down here to under 20 back in the turn of the year. And then it had a huge run up from 20 up to 40. And now it seems to be meandering here at around 35. If it starts breaking under, 35, 30, again, that would be indicating that maybe the consumer is not spending quite as much money. If there is weakness coming in the consumer, which nobody is really predicting, right? Nobody's predicting. Well, a couple of companies to keep an eye on would be Visa, and you can see how high it is. So is there a put opportunity up here on Visa? Well, if the consumer is going to have some problems or they're not going to spend money like they have been spending, that's something to look at, right? And has Visa gone up a little bit? Well, it's gone from 100 to 150. That's a pretty big run. And you can see the volume has been very high lately. So again, if the volume's high and it's not moving very far, that might not be a good thing. You see when the volume got very high back in last February, we were at the low at 110. Well, it could be conversely happening here as well. High volume in September, and the price is really not making that much activity. So there's one to take a look at. Let's look at the moving averages on Visa, because, the whole world is long Visa, as you could imagine, right? So when everyone's doing one thing, somebody's got to be doing the other side, right? And sometimes the other side isn't so stupid if you look at a month or two. We are at 128 on the 200-day average. So you're about 25 bucks above the 200-day average where we're priced now. You see the 200-day average 128. Okay, so could there be a pullback in Visa? It would not be would not be impossible. The high was made yesterday at 150.64. So keep an eye on it. There's no evidence of a turn, but if next week we fail to take out this week's high, or we get some formation of a high surrounded by lower highs, and the consumer is going to be a little more dodgy than he's been, that would be a stock that would be probably affected to the downside. Let's look at another one, MasterCard. And MasterCard is, and by the way, these are very heavily held companies in most of the ETFs and things like that. So basically, you are looking at a situation where if they did sell out, there is quite a bit of people in these companies. The volume and the amount, look at the amount of shares on Visa there, gives you an idea. Hold on one moment here, and I'll give you the MasterCard. Go, MasterCard, here we go. Yeah, MasterCard, same story, right? You're way up at 224, which is pretty much the all-time high, which was probably made somewhat recently. You're at 223. And, it is a situation where it's come a long way, right? From 140 up to 230 almost. So again, keep an eye on the credit card companies because they have had very big runs, and they are obviously everyone's betting the consumer is just going to keep spending like crazy, and maybe it will be tempered. Who knows? But there could be an opportunity. Keep an eye on that. Okay, what else is going on here? Is the price of oil is taking off, right? And we got oil up at 73 and change. So could there be an opportunity in oil? Well, let's take a look there. As far as oil is concerned, one company I've been focused on is ConocoPhillips, and that has been a very good friend of of the bulls, as you can see, making all-time highs here. Well, almost all-time highs here today, but certainly broke above the 70, 75 area, and so there is some upward momentum on that one. That's had a big run, but there's a reason why it had a big run. The company's making quite a bit of money, and with oil rising, it could continue. Another one that has just begun to turn a little bit more, and maybe offers a little bit more, less of a move already happened, would be Anadarko. And Anadarko is up today, 67.47, and the moving averages I think are right around the 65 area. And so as long as they stay above 65, and you can see 60 was the low, and you can see 65 was resistance, and you can see now that it's trying to get going, if it can get going a little bit more. 70 would be a target on a short-term basis, and then 75, and then above that it would be into new highs. So there's a couple of companies there that I've been looking at on the oil side, and of course you always got the ETFs you can play in that way as well. Another sector that I've been focused on is the industrials, and they broke out pretty good to the upside, but I'm sure the way the market's been trading, they've been bouncing. One of the industrial ETFs that I watch is Vanguard. There's plenty of them out there, but this is the one I've been watching, and it did have a pullback. After this thing hit 140, I did think that it looked like it might go to the upside, and it certainly has. Broke above 145, which is also a good price to be above. And the industrial companies have been going pretty good. A lot of the transport had been doing pretty good, and you got a gap up there around 150, and the moving averages come in around 142 to 145 area. So it's trading above the moving averages. So it's still in a constructive point, but the bloom came off the rose a little bit in the last week. The Fed hiking rates and talking about hiking it again is an indication that they're not trying to stimulate the economy, but do more to moderate it, because they realize that bubbles are not good for anybody, because when they burst, they can be real painful. President Trump obviously would like to have as low interest as possible, because remember, he is a real estate guy. He likes to borrow lots of money when he does real estate deals, and then he likes to speculate with that money in real estate. And that can work out good when things work out good, but then in Atlantic City, when you speculate and build a bunch of casinos and people don't show up, that means the revenue doesn't follow, and all the expenditures you came out with does not have revenue to support it, and ergo, that's how you go bankrupt. So, the government and the Fed is very well aware that deficits are rising, and they're going to rise further. And obviously, the moves by the administration and the government is that the moves will increase tax revenue, and that the deficits will not be a problem. But like anything else, when you're looking on the come line for revenue to show up that has not showed up, and it does not show up, and you're hung out with all these deficits, it can be a real problem. And it's going to be a lot bigger problem than Atlantic City was, because now we're dealing in trillions of dollars, not billions of dollars. So basically, you got to be careful out there as far as the finances are concerned, and the Fed's not going to be crazy and keep interest rates at 2% and try to get the Dow Jones to 50,000 by next Friday, because they realize there's a reaction to every action. And nobody has a vested interest in a big bubble bursting and everybody having a problem like 2008 or worse. Looking at the financials, that was another one that everyone in the planet has been positive on, and for whatever reason, it doesn't seem to be panning out, right? Banks, buy the banks, buy the banks, right? You heard that plenty of times, right? Well, it went up to 30 on the ETF XLF, and as you can see, in January it hit 30, went all the way down, 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 then it came back up recently to 29, and now it's back on the defensive again. So again, people think that with the stronger economy, loan demand should pick up. I don't know that that's happened. And they also feel that the banks are going to be profitable because rates are higher. Problem is that short-term rates are going higher much more than longer-term rates. And when people go and put their deposits in the banks actually have to pay now, right, with CDs and stuff like that. And the loan demand, if there is any, is probably for longer term debt. And the difference between short term debt and long term debt is very minimal, which means it squeezes your profits. So I think that's the story behind the story on why the banks can't get out of their own way. I do think that they could have potential. Everybody's in love with Citigroup because of the valuation. They believe it has very good potential. Let's take a look at Citigroup. And you can see that it was trying the banks, and now it's not going very well. So basically, again, this is a company that went to 80 early in the year, went all the way down to 64. That doesn't look bullish to me. Popped back up to 76 here, and now it's rolling back over. If it gets back above 76, it might be very worthwhile to take a look, and maybe the bullish story on the banks would be risk on. But right now, all it does look like is had a dead cat bounce to the upside, and now it's trying to come back down. Keep an eye on it though, because there is higher lows, right? Higher lows there, and that's not bad, and some higher highs recently, so that's not bad. So I'm not saying throw it to the curb. I'm just saying that the jury is still out on it. But if in the month of October and November you start trading 74, 76, 78, then again, that big 10% jump that people are looking for in the stock market, possibly after the midterms, that would make more sense. So again, I'm very respectful that there could be a run up like that because the S&P went into new high territory. But I'm also been around the block a couple of times, and I know when everybody's saying one thing, you better start listening to the other story just a little bit, or hedge against the other story, which means you use covered call writing. You use covered calls and buy some puts. You use some married puts on things, which put parameters around your equity, which maybe preserve some of these gains you might have. And then basically you can adjust the hedging technique as the prices come out of the shoe. But the point being is that you don't hopefully just sit there and watch the elevator that went way up come back down. Okay, so we went over the industrials, we went over the financials, and we went over the consumer stuff with regards to retail and the credit cards. And so basically, I would like to go over a couple of other things here. The materials. This is another one that people have been kind of getting bullish on. Let's see how they're doing. VAW is the Vanguard Materials ETF, and it was trying to run up, but again, you can see it's given up a little bit as well. So like I say, this is not positive action lately, and that's why you got to be careful. A lot of bulls out there, a lot of people long stock, a lot of people talking very optimistically. Some people have said that the administration is kind of like a positive mental attitude type thing, where they always use words like incredible and fantastic and incredible and gigantic and stuff like that. So they're almost a motivational speaker at times. And the good thing about a motivational speaker, it can get you to act, and sometimes it can get you acting a little bit irrationally. So be careful. And like I say, respect the charts, respect the moving averages. They're based on price, they're based on time. And those are not bad things to use as a reference point, in my opinion. What else is going on out here? Let's talk a little bit about interest rates. If you're in the bond market and you're losing money, something that I've been telling people to consider is shortening your maturities. I mean, I've been saying that for a while. You can be rolling even 90-day T-bills and getting well over 2%. And, 2% for sure with your principal back looks pretty good when you're on the wrong side of bonds. Some of these bond yields are, not much more than that you received, right? I mean, if you bought any bonds or fixed income in the last few years, you've been getting 1%, 1.5%, really lousy stuff, right? And now you're stuck in something that goes 5 years, 10 years, 20 years. That's not a good place to be. So shortening your maturities, which means you go into treasuries short term. And take it and keep rolling them, because every time the Fed hikes and you go roll your T-bills, you're going to roll into a higher rate. When those rates start coming down, then you extend the duration. You understand? So if you don't understand, again, OptionProfessor@gmail.com. Any questions you have on any of the stuff I'm talking about, please feel free to give me an email, and I'll communicate with you accordingly. And again, I'll give you my opinion and my view, and you can put it into your mix if you'd like. With regards to, so the treasuries, again, they went up to 310, and that's basically the area of resistance. So now it's come back down a little bit. You probably will try to get around this 3 area. Again, one of the scenarios is in November, December, you're going to have crazy stock prices on the upside, possibly because of the elections and other factors, and or maybe earnings are giant, something like that, or GDP numbers pop. And if the market is going to have that kind of rally, there are people who think that these rates will spike up as well to 3.5% or better. That's a scenario out there from some people, and again, I still respect that scenario, although I'm not seeing evidence of it yet. You start closing above 310, 320, I'll definitely buy into the spiking up of interest rates. And if you start, getting some of these ETFs and stocks that I mentioned above those resistance points of recent time, of course, then I'll buy into the spike up as well. You don't want to fight the tape, but you don't want to buy into a tape that doesn't exist. So, right now, this 10% melt up on stocks tape really doesn't exist outside of the fact that we've made new highs on these things, which shows that we broke the ceiling. But after breaking the ceiling, there's not been tremendous follow through. A couple of other things I'm watching on a short-term basis that got me a little concerned was the transportation average breaking under 11.5. Let's see what that's doing today. Yeah, so it's up a little bit today at 11.390. But can you see getting under 11.5 on the transports was not really a positive. And if we take out the lows that we've seen this week, then going down to 11,000 on the transports is not out of the question. Conversely, we get back above 11.5 and get cooking. Again, another indicator that the train is turning back north. So keep an eye on the transports. We get back above 11.5, 11.6, that would be outstanding for the bulls. And if it starts breaking under 11.3, 11.2, and starts breaking the other way, then that would be your caution flag. Keep an eye on the transports. And then basically the Russell. The Russell is the one who's supposed to benefit the most from the tax cuts because of their smaller companies, and that did break under 1700, which I was not a big fan of. It has come back up here to 1699 today, but keep an eye on that as well, because if it starts breaking substantially under last week's or this week's lows, again going down to 1650 is not out of the cards. And if it does that, obviously that 10% melt up in November and December would be very much at risk. Here again, getting back above the weekly highs here, 1720 would start to get me thinking that the train's turning north. So let the Russell and the transports start getting stronger and get back above their resistance points now. And then that could be evidence that we could be seeing some kind of a turn to the upside. That and some of those banks I showed you where there was some resistance, and if you can get above there, that would be a positive as well. Same thing on the industrials I showed you. They're on the defensive. Can they take out the recent highs? If they can, then that melt up thing later in the year starts having more veracity, in my view. Okay. All right. So that's, I think we hit the stocks pretty good here today. And let's talk about the value of the dollar, which is coming into play quite a bit. And let's see here on the dollar. Again, my view on the dollar, if you've been listening to the broadcast, is that 97 was a turning point on it, on the dollar index. And right now we just had a spike up, but now you can see it's back down a little bit. So this high recently, about 95.40. If next week we don't take that out and start rolling over, I still think it's on the defensive. Again, our interest rates versus the German interest rates, ridiculously large spread. So that's helping the dollar quite a bit. And foreign countries that borrow in dollars and receive their cash and income in their local currencies, like Argentina, like Brazil, like Turkey, these guys are getting into a dollar squeeze because they need to come up with dollars to pay back on borrowing that they do in dollars. And they're getting local currency that's tanking. So your revenue's coming in a tanking currency, and your expenditures are going out in dollars, that means you need to buy dollars, and that's why there's been such a strong dollar squeeze up to 97. I'm sure that 97 was very close to when there was a lot of bad reports coming out on Turkey and those people as well. So at any rate, my view on the euro was that 115 would be the low, and it would trade up from there. It is trading up from there, but it did go a little lower than the 115 area. It went to 113 and change, but now it's above 115. So I would say 97 is a line in the sand if you wanted to be thinking the dollar may lose value. And you would be looking at 115 on the euro if you thought the euro was going to gain value over the months ahead. So that's pretty much the story on the US dollar. And again, the dollar being somewhat stronger lately, it put gold back into the corrective mode. Gold's at 1194, I believe, today. Silver at about 14 and change. The gold to silver ratio is still above 80. I think if the metals were in a bullish trend, you'd see that ratio collapse quite a bit, meaning silver would have a much more significant percentage advance than gold if the metals were in a bullish situation, which right now they are not. But again, they are out of favor. If the dollar is going to have a rollover going into the end of the year or next year, then the metals would have some value down here. If not, and this differential on interest rates between the US and Germany and Europe is going to continue to widen, then the gold may have some trouble. So very much dollar oriented and inflation oriented, looking for figures like that to give them some kind of lift. One other thing that I mentioned in prior broadcasts was the discount on platinum to the price of gold, which would mean a spread trader would be buying platinum and selling gold. And I brought that to your attention at 425, meaning platinum was at a discount to the price of gold of about 425. And now today it's about 370. So that spread has tightened up by about 50 bucks from when I first brought it to your attention in earlier broadcasts. You know, my history, platinum trades at a premium to gold. So seeing it at a $425 ballpark figure discount to gold seemed extremely odd to me, and apparently to other traders as well, as that spread has come back into about 370. I still think it's pretty wide. I'm not a 100% expert on the backing of the reasoning behind the discount. But I do know that the discount itself looks like it's out of line historically. So basically, that's the look at the metals. And of course, copper's been on the defensive. So the metals still are in a quandary. One thing that is looking interesting, if you're looking in the commodity sector, is soybeans. And again, Trump is trying to bang the soybean drum here because he wants to get those votes. And so he is the friend of the farmer, according to Mr. Trump. And so if he's going to try to make some maneuvers to help the farmers before the elections, then there could be some value here. Let me just see what we can get here real quick. Hold on. All right. Give me 1 second here and let me get this up to you. But, obviously the soybeans have been in a very bad condition here, technically, because they have been coming down and down. But I thought the 850 mark was kind of interesting. So basically, I was going to show you here, and it's coming up right here. If you could just give me a moment, the price of the soybean chart. I thought the 850 mark was kind of important. And let's see here. Yeah. See, getting back above 850 here, I think is a little bit of a positive. You got your line in the sand at 810. Obviously, you don't want that taken out. And where could it run to? Well, it could run anywhere it wants to if the news changes on it. But my first stop on it, I think, if it got some legs, would be around the 9 area. And then if we got above 9 and took out the 925, then it could have an extended run up to 990. So is there a possibility of a bigger run coming? It is possible. It has a little bit of a look of a head and shoulders bottom there, and it does seem to have a little bit of a situation to the upside. Again, a lot of times it's good if you have a position going one way is to take a limited risk put the other way, which means you have a hedge on. Sure, if you're right and the market's going to go through the roof, you are going to lose on your put insurance. But if the put insurance is not that much and the upside potential is significant, you can afford to take the hit on the put, because if the thing starts falling apart and takes out 810, and you have a long position, at least you have some hedge on the risk. Or if you do a strangle means you take a call, limited risk buy, and then you take a put, limited risk buy, a little bit out of the money on both sides. And then you're looking for the movement on one side to be such volatility that the premium on the option will expand so dramatically that it can offset and then some what you paid for the put. So a long strangle position is limited risk. You do need to see significant volatility to be profitable, but if prices do get very, very volatile on one side, it can and would more than likely offset the other side put that you had paid. And at least every night when you went to bed, you knew that if it went way up or way down, you did have a position that could benefit from it. So that is the last thing that I pretty much wanted to cover here today. Again, next week we are going to probably see more additional volatility. I would like to see, if you are bullish, to see more strength in some of these markets, which got a little bit staggery here this week. Nothing dramatic. But if staggering this week turns into accelerating a little bit to the downside next week, then of course you're going to get a much better buying opportunity if there is going to be a rally at the end of the year. Again, keep an eye on the markets. And again, next Friday, I will be covering an update on these things and give you more insight on what's going on right now. Again, this week, big news: Tesla in trouble with the government, and stocks in big trouble on the board. Interest rates hiked this week, and an indication that we got another one coming in December. That's the big news this week. And of course, politically, big mess down there with everybody arguing with each other. Can't breed too much confidence, but we'll see how that shakes out as well. Again, I always suggest to take down the email address, optionprofessor@gmail.com. OptionProfessor.com, at gmail.com. Send over your questions, send over any inquiry you might have. I'll be more than happy to give you a hand. Until next week, I'm Jim Kinney for the Option Professor Weekly Update, September 28, 2018. Until next Friday, have a great week and a good weekend, and always good luck on your trading. See you then.